Joining us right now is former Dallas Fed President Richard Fisher. He's a senior advisor to Barclays. He serves on the boards of Tenet Healthcare and Warner Brothers Discovery and is a CNBC contributor. And Richard, we don't get to talk to a Fed president, but we get to talk to a former Fed president, and that is pretty darn good for us. So what do you think after that Friday jobs report? It was definitely hotter than had been expected. Is that going to change Jay Powell and companies' minds?
I don't think so. There's just came across the wire. Again, the Fed whisperer, Nick Timeros, arguing that they might possibly make 250 basis point moves. So this December 14th to be announced, and then in February. I consider that a reasonable thing. And I think the main point here, Becky, is we're still going through this adjustment from free money to money that costs. And it's sort of a jerky process in the markets. One of the best investors I know has described it as going from driving automatic to stick shift and, trying to get that down, jerking back and forth, back and forth, back and forth. And I think that's what we're seeing in the financial markets. I don't think that dissuades the Fed, and certainly not Chairman Powell, from doing what has to be done. And it's pretty clear they're not done.
We're looking at the Dow futures right now. Maybe we can put this up tick by tick for the Dow futures, which are now off by about 240 points. We'd been down earlier this morning, but it was closer to down 150. My guess is that's a drop that took place, just as you mentioned, that WSJ headline crossing. You can see right there. We've ticked lower, probably just on the assumption that things could be 50 basis points, and then the Fed waits and sees to figure out what's happening. You can look at the futures or you can look at the bond market. And the yields there, Richard, are indicating that the bond market seems to think the Fed is going to pivot sooner rather than later, that there's enough damage that's been done that they will have to be pulling back. 3.553% is the last tick. Which one do you believe? Who's got the bigger heft when it comes to this?
I'm not sure markets are great indicators here. Again, there's so much uncertainty. If you look at the yield curve, what's interesting is the 1 year is stuck at very high levels and everything else has fallen off as you proceed out the yield curve. What that's telling you, I think, is they expect some tough stuff in the short term, but that it's going to work. And therefore, you see the 10-year has come down dramatically from its peak of 4.3 to where it is right now in the 3.4 range, 3.5 range. Mm-hmm. And even at the 3-year, the 5-year, the 7-year. So that, to me, is an assumption by the marketplace, right or wrong, that they'll get the job done. But that short term, it's going to be expensive. And look at, again, where the 1-year yield is. So I think the main point here is I'm pretty certain, as I understand Jay Powell, having sat next to him for 3 years and having talked to him every now and then, the worst thing they could do is stop early. They already made a mistake by embracing this transitory argument. They look bad. They stop early, and then inflation continues on or roars back, particularly driven by wages, especially on frontline workers, not white-collar workers. And then they have to come back and tighten again. That would be, I think they'd go down in the books as having done a very bad job.
You mean it's better to hurt the economy too much than to lose face?
I think he's basically said that. He didn't say lose face, but there's a danger in not doing your job. And that's the way I read Brookings, his appearance at Brookings. Everybody said, oh, he's massively dovish, et cetera. I thought he was quite deliberate and signaling that they're going to do this as long as it takes to get it done. And it may last longer and at a higher level and stay there than some people are guessing or the consensus has it.
Lasting longer and leaving it there for a while is different than continuing to raise rates beyond the level that are needed. And I mean, there's so much. If you listen to some of the CEOs we have on who have seen real struggles in their businesses as a result, they'll tell you that they've already done too much. If you listen to Larry Summers, he'll say it's going to be way more than the Fed is even indicating at this point. Which camp do you come down in?
Well, Larry is ubiquitous. He's everywhere these days, but he's very, very smart and is a friend of mine. And I think that he's probably closer to being right. I can see a terminal rate that's above 5% and holding it for a while. So, but, Becky, I just came off a huge victory, which is the Dallas Cowboys last night, 54-19.
33 points in the
I'm a little ebullient.
quarter.
Yeah. I want to be generous, but I just need to be
straightforward.
straightforward.
That's you feeling good about things. That's concerning, Richard.
Richard.